Hello, everyone. Welcome back again to the channel. We have two special guests with us today from Gustin Cho Associates, two great loan officers who I've known for a few years, Alex Carlucci and Dale Elenteni. And we're going to talk today about debt to income ratios and how to lower them. When the rates were really low, people were able to qualify for almost any loan amount they wanted to, but then as rates climbed, they found that they were trying to maybe buy a house or qualify for a specific loan amount, but with the higher interest rates, were having difficulty in some instances qualifying with because their DTI was too high. So what we're going to talk about tonight are a few ways to lower your debt to income ratio to help you qualify for a higher loan amount or the mortgage amount that you're looking for. So I want to kick it to either Dale or Alex, and maybe you guys can come up with one idea on how to lower your DTI.
I've got a bunch here. So, I mean, obviously the first one and the easiest one is I buy the rate down. So, let's say if I just need a couple little ticks on the points, and let's say going rate for you 7.25, and it costs $2,000 to buy you down to 6.875. I'm going to suggest that to you. So that's one of my first ones. I also like to look at people's credit cards. I look for small credit cards like $400 or $500, knocks a $30 or $40 payment off. It just depends how much money people have and what they're willing to do. You can
All right,
always,
so wait.
yeah,
So I want to clarify what you just said, for those who are watching. What you're suggesting is if you have a small credit card balance, but you've got a payment that's sitting there, knock it off, get rid of it, so that way you have a zero payment balance. Is that
right.
correct?
Yep.
Okay.
And then, so a lot of loan officers might make a mistake and not exclude like installment debts that's less than 10 months. So if you got a car payment less than 10, you might get loan officers that don't realize they can omit that. So that's just something that they might miss that we won't miss. If you got a
Yep.
lot of student loans, I recommend the IBR payment. And that what that is it reduces what the regular payment would be. So you go on a payment plan with the student loan companies, and it's a lot cheaper than the payment plan they probably have you on, or if it's got zero because they're still deferred for whatever reason, you can get an IBR payment. It's called income-based repayment plan. But if you're a veteran, I recommend that you defer your student loans for greater than 12 months after closing. So what that means is that if I'm pre-approving you, I have you call the student loan companies and say, can you defer them for greater than 15 months? That gives me a 3-month window to get you a contract and close, because it has to be 12 months after the close date, when the next payment's due. So if they're due a year after the close date, they count zero against your student loan. So that's a little trick for veterans.
All right. So
Um,
let's back up a minute. I want to go back
sure.
one where you talked about your student loans and negotiating it into a different payment process.
Yeah,
So so with FHA loans, you have to use, even if it's deferred, you have to use a 0.5%
correct,
of the outstanding student loan balance as your payment, even if you're not making a payment.
correct,
That's what's going to go against your DTI.
correct.
So so what you're suggesting is go this other route, and only if the new payment is less than the 0.5% calculation,
Correct.
correct?
Yes. And if you do go
Okay.
on an IBR payment and they offer you zero, don't take it, because FHA won't accept it. FHA will not accept a zero payment.
Right. You want to negotiate as low a
Dollar.
payment as possible, but not zero.
Correct.
Okay.
Um, VA will also take um, that negotiated payment if you want to do that too. So you can do an IBR for VA too, but if you can get it deferred, we can eliminate that. And we can,
All right.
Alex, let me
yeah,
add something.
sure.
As loan officers, instinctively, when we run AUS or automated underwriting findings, and if we are fortunate enough to get an approval, we instinctively want to go get 2 years of recent W-2. So right now we're in 2023, so we would get 22, 21, or in this case, because we're in December, we would get 22 and use the year end for 23. But sometimes the automated underwriting findings only require 1 year W-2s. And that can make the difference in your qualifying income, which will change your debt ratio.
Yeah, absolutely. If you're
Yeah,
self,
And
and some
Dale, you want to talk a little bit about, what are the reasons why the automated underwriting system would only request? Is it if you've got high credit, or what are the factors or the compensating factors that would result in the findings asking for only 1 year?
But that's a really good question. So I have a father and son right now, who are going to buy a house together. The son, the father. Let's start with the father. He's got a solid job history for like 3 years, with like a 780 FICO score. They only wanted 1 year W-2 for him. The son's got a 740. He's not that bad, but he's been at two different jobs in the last 2 years, and they want 2 year W-2. So I think there's a lot of things factored in. What's the depth of credit? What's the length of, what's the job history like? What are the assets like? There's a lot of things that go into it. I don't know the exact science of how algorithmically it figures it out.
They don't
But
want you to know. They don't want us to know.
but
Go
we can
ahead.
kind of tell after looking at enough of them
Right.
that, oh, okay, that kind of makes sense. So
High credit scores, lots of money in the bank is a good one. Those are the
yeah,
two.
those are strong compensating factors: high score, good assets,
Yeah.
that
Mhm.
type of thing. But that plays a part. Like, I've had to push back on underwriters. Oh, I want 2 years tax returns or 2 years W-2s. I'm like, well, the findings are only saying 1 year AUS, and that's going to change the purchasing power for the borrower. And I've gotten them to back off. But sometimes you got to point it out to them, because they instinctively all ask for it as well.
Right. They probably didn't even notice the findings, and you're just
Right.
asking.
They're just it's on their punch list, 2 years W-2s, and then you got to show,
Right.
look at the findings, one
Right.
year
Right.
AUS.
A lot of people
Yeah.
don't, a lot of loan officers don't look at those findings and give the 2 years. The next thing you know, it's,
Right. They see approved eligible on the top, but they don't read what's below.
yeah.
So what is it gonna?
So I
So
always go to that real quick to see if that's an option.
okay, got it. Okay, what else have you got, Dale? Or
So
is it you, Alex?
so let's go back to the VA. So the deferment's a great one, but VA is always the best because they go the highest DTI. We go to 65 DTI, even higher than that, but 65 is a good number, percent DTI. But so what VA does for a refinance, not a purchase, I find that I found some I've made veterans very happy. They didn't know this for they've been in the house for years and they're 70% or greater disabled, that they can go into the county assessor's office, the tax assessor's office, and get exemption and get their property taxes waived. And that will chop your DTI considerably and also save you a ton of money over the rest of your life. A lot of veterans don't know this. So when it comes to a purchase, the underwriter will not accept the exemption for disability, 70% disability. But on a refinance, if they have not executed their disability exemption with the tax assessor's office, you can have them do that during the process and get the taxes down to zero. So that's a great trick.
Alex, two questions for you on VA. So elaborate on two things. The 12-month deferment on the student loan. So if you get it supplemented on credit, it's clearly saying it's deferred for 12 plus months.
That's what you need, a supplement after you close. They don't, it has to be. So if you look at student loans on people's credit report, you'll see a lot of them are deferred for 2 years. Like 2026 is the next payment due. You don't need to do anything on that. It's already there. If it's not there, you have them call the student loan company. They agree to it. Then you do a credit supplement and add it. But
And then, okay.
yeah, so yeah, that's all I gotta say
And
about it.
then 70% disabled, if for whatever reason they didn't go file for their exemption after they bought the house, and now they're refinancing, like they're doing doing a full blown refi. They could
Yeah.
show that the application's in process to have those taxes exempted or wiped out
They have to get a stamped approval from the county, the
from the
tax.
county.
Yeah.
Okay.
Yeah. I've had underwriters take the stamp that's going to be, some want it recorded and wait for the state to be able to pull it from the tax bill. But I want to go back to the student loans. Deferment is a special word when it comes to deferred student loans. It's not forbearance. It's not anything else. Deferred is a special term. It's got to say deferred. So don't get confused with forbearance. So if your loans are in forbearance for VA, that does not count. Deferred. Keep that in mind.
Mhm.
All right.
Hey, I got a question for you guys. So when we talk about excluding liabilities, like installment debt less than 10 months
Correct.
on a conventional loan is excluded. How does that, Alex? How does that compare to FHA and VA?
They're all I think they're all the same.
Is it all uniformly the same
Yeah,
now?
I think they all have a little bit of a difference in percentage of income. So let's say you got a $3,000 car payment and you make $4,000 a month. You can't exclude that $3,000 car payment because it's more than 25% of your monthly gross income. So there's a weird nuances with VA, FHA, and conventional. I don't know those off the top of my head, I'll be honest with you. So we could
Okay.
research that and get back to you on that. But they all accept the less than 10 months, but there's nuances of how much that payment can be.
As a percentage
Okay.
of your gross.
A
As a percentage of your gross.
gross, yeah. 5%, 10%, 25%, I'm not sure what, but there's some rules to that.
So, okay, we'll find that out and get back to
Yep.
everybody on that.
Yep.
I'd like to know that definitively as well.
So another one I just helped one of the loan officers on our team just a couple days ago, $4,800 insurance. There was nothing wrong with her claims. The insurance just kept going up and up and up, and she didn't know that she could challenge it. She went to a company, we referred her, and she got $2,000 a year insurance. That knocked $230 a month off.
Okay. Since you brought up insurance, homeowners insurance,
Yes.
that was going to be one of mine, but
Okay.
one of my tips was to speak with your insurance agent and ask about raising the deductible
Correct.
to get the lower insurance,
Correct.
even if you
Yep.
do it for 1 year.
Yeah.
Absolutely.
You know?
Let me tell you
So-
about insurance. Yeah. So insurance companies, if you don't do anything about it, they'll just keep raising it every year. And your policy, you did nothing wrong. If you just leave your company and go somewhere else, you get a better deal. A lot of people don't know that. It's that
Yeah.
easy. But go ahead. Sorry, Eric.
No, that was it. It was just, I know that you can get lower, even automobile insurance, which won't show on your credit report, but right, unless you've seen it at times. But homeowners insurance, yeah, if it's no different than auto where you ask for a higher deductible, meaning most people get quoted at a $500 deductible, but
Yeah.
ask, hey, what about 2,500?
Right.
Yep.
And what will my premium be? And I think you do that if you're close, if you're like, $50 or a month away,
Right. Right.
that kind of thing.
Right. In my case,
So,
I say,
Eric,
yeah, go ahead.
I've done, and I'm sure Alex, I'm sure both of you guys, I've had several FHA deals where you're at that max debt ratio, 56.9. You got the approved eligible. Maybe the underwriter came in slightly less on your income calculation. Now you got to find ways to to bridge the gap. So maybe I got $100 I got to make up. Yeah, increase the deductible on the insurance, and maybe you pay that small credit card off like you were talking about. Now you
Yeah.
get it back to 56.9 and the deal works. It's that close
Right.
sometimes. It really
Right.
is.
And sometimes people, when they add their car to their home insurance, it reduces the home insurance part of the payment. It might
Yeah, they
just-
bundle it. They
the-
bundle
the
it.
bundle,
Yes.
correct. So that's another way, just by requesting that could lower your policy.
Mhm.
Well, Alex, your suggestion, I'm going to make a call this week for my own insurance and make sure
Right.
I'm getting the best deal. You know what I
Right.
mean?
You
Right.
really need to. In fact, as a sidebar here, you everyone needs to do that with their cell phone bills, everything, because they're not going to call you and tell you that there's this great new plan where you can pay less.
Right.
You have to call as if you're going to leave because it's too expensive. Then they find something for you.
Every couple of years with my cable company, I have to threaten that I'm going to leave, go to the concierge help, where they're going to save me, and then they lower my cable bill by $80 a month, but they jack it up.
I'm right there right now with my cable provider. And hey, like you said, you almost get punished for being loyal, right?
You do. The new people get, the first year free, no cable bill.
Right.
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 I've been with them for 25 years, and I got to fight with them every 2 years.
That's it.
Yeah.
So what else have you got, Alex and Dale?
So we'll just expand on these. So add a co-borrower. If your DTI is too
Right.
high, there's no solution.
Yep.
Add a co-borrower. Now VA doesn't let you do that unless you're married or another veteran. So VA is not so easy. But if it's FHA or conventional or a non-Q1, add a co-borrower.
That was on my list, but the co-borrower needs to have a lower DTI than you. Otherwise, it doesn't make sense.
Right. They can't be.
So,
they have to do
Alex,
the job and
I've got one right now, Alex and Eric. So I've got a couple that I did a VA purchase for about 6 months ago, and they had a higher DTI there at like 59. Her brother, she referred me her brother. He wants to buy now. She offered to co-sign, but his DTI is still too high. So now we're thinking about putting my original borrower and her husband on as two co-borrowers to make this DTI work.
Yeah.
Is that something you've done before? Two co-borrowers?
Yes, you can. FHA, you can have 5 people on the loan. More than that. I don't even know what I don't think there's a limit. I'm not sure what.
What a nightmare of loan
Yeah.
application, but
Yeah, I don't want you guys. Stay away from me. I don't want 8 people. I'm just kidding.
So yeah, my DTI is at like 61 right now. So I've got to get him to obviously 56.9 or better. So we're close, but it's going to take probably a second co-borrower to make it work.
Yeah. So just remind me of some things. So a lot of people don't gross up Social Security, child support, certain types of income the proper way. And sometimes that's the trick too. A lot of people make mistakes on that. It's very complicated for some of these loans on how to gross up
Right.
Social Security, because if you have an income, you have to look at the tax returns. And some people say, oh, you make too much. They don't look at the tax returns and realize you can milk a little money out of the Social Security income too. So keep
Yeah.
that.
I got one for you since the thoughts are coming to our head. How
Yeah.
about times where you have somebody, your borrower is an authorized user for, like, say, like a parent's account, and there's an active balance with a decent sized payment, but that's hurting your debt ratio. You got to remove them as the authorized user, and hopefully it doesn't hurt the FICO score.
Yeah.
Or you can prove the authorized user, the other person's paying it for the last 12 months and they'll eliminate it.
Okay.
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 Well, that's good.
So
Yep.
that brings me to another one that I have written down here. So with conventional, they changed the law about it a year and a half ago, 2 years ago. It doesn't matter if you're on the note, not on the note, first, listed second. If your family or anybody's paying your payment for 12 months, you can eliminate that debt. So if you that keep that in mind. Now, FA is a little more strict. They want you to be listed first, the co-borrower, whoever the person is, who you're trying to eliminate, has to be a true co-borrower on that note, and you have to prove that the other person made the payment for 12 months. Conventional doesn't care about anything. Like it could be, it really is your debt, but your parents are paying for it, and they bought the car for you in their name, but they put you on as a co-signer so you could earn some credit, but it's really your car. Doesn't matter. Conventional doesn't care. FHA wants you to be a true co-borrower. So if you're put on the note first, it's your debt no matter what for FHA. I hope I didn't confuse you there with that, but it is confusing. Just remember,
Right.
you have to be a true co-borrower to eliminate the debt FHA and prove that the main borrower paid that debt. That's
Got it. That makes sense.
Next one is negotiating the purchase price. Let's say you're off by a little bit. Hey, just try to knock it down 5,000. Try to win them over, or put a little bit more money down. So those are two options you could do if you're tight.
Yep. I had a larger down payment also, and with FHA, the more you put down, the lower the monthly mortgage insurance premium will be. The calculation changes. I don't know how much it impacts your actual payment, but what I'd rather do is
Buy the rate
down. Either buy the rate down or take that money. Like, for example, negotiate seller credit to pay for closing costs, and you take your closing costs money and you pay off some of these credit cards or whatever it is. Where
Totally.
Payment.
Yes.
You know?
Absolutely.
Yeah.
I have more success with that typically.
Let's say you don't have any credit card debt, then you put more money down. How about that?
Yeah.
Yep.
Sure. Or I think buying the rate down, to your point, will get you
More bang
of
for
a
your
monthly
buck.
payment, a discount, or lower your DTI more than the loan amount being reduced by 10 grand.
Yeah, $5,000.
Or pay a car off to less than 10 payments.
No, you got to do that and rerun the credit. You can't do it during the process. They don't let you pay it down during the process. You have to rerun the credit and don't let the underwriter know that happened.
Okay, well, we'll just keep it between us, okay? Don't tell anybody.
Do it before you send it to underwriting, because you should know anyway.
Yeah. And re-pull credit with that updated how many months left kind of thing.
Yep.
Another one on a refinance. Let's say you're doing a cash out refinance. Obviously, paying off your debts. That's an easy one.
Of course.
That's a simple one, but it's a lot of people probably already know that. But I thought that's another way to get your DTI down.
Yep.
Another one is if you want to, let's say that let's say you have a collection that's $3,000, and they're hitting you for $150 a month. You could pay that collection to delete it and see if they offer a deletion. Wait a few weeks for the collection to fall off. You'll save that 5% rule, which is $150, and your credit score will go up. So you'll have a double whammy there. You'll get your credit score boost, which is
one
of my other ones. Get your credit score up, get you more DTI. So if you're only getting approved at 48 DTI because you got a 602 credit score, and we get you to 620, now it's going to approve you to 56.9. So if you pay a collection to delete it, you not only you eliminate the 150, you might get a credit score boost and get more DTI, better rate, just a bunch of things moving there that are help you get your DTI down. So you got three things that can help you: a better rate, more DTI approvability because your score is better, and you get rid of the collection 5% rule.
Mm-hmm. Right.
All
So
right.
I've got the other part of your payment besides principal and interest and insurance, you've got taxes and HOA. So you could find a home that's got lower taxes. Taxes are a huge thing. You know, you guys know, you find someone that's 13 grand in taxes, that's killing their buying power, you know?
Yeah.
Yep.
You find a home that's got lower taxes, or if they've been looking in an association or a condo, you know, ask them to, if they need to qualify for a higher amount, maybe consider a place that doesn't have an HOA. You know, it's
Yeah.
another one.
Yeah.
I visually lay it out almost like on a spreadsheet. If Eric, if you're my customer and you're looking in a certain price range, let's say 300,000, I'm like, here's a range between 325 and 275. Here's 6,000 in property taxes, or here's 8,000, here's 4,000. They could really see how it impacts their payment. And they could filter their search with a realtor saying, okay, I want to look for houses in these towns with these taxes, these purchase prices, and they could filter those searches.
It's absolutely true. I wish there was more inventory right now, so they
Right.
had the ability to find that
It's
many
going
homes
up. I'm seeing it going up. I'm watching these sites. They're going up. And it's odd when inventory goes up in December, just so you know, it's going up. It went from 500,000 to like 600,000 listings nationwide. So
Yeah.
maybe we'll get something. And that brings me to my last one that I have written down. Not saying that that's all of them, because there's no way I can remember them all, but this is a good one that may come into play now that you could not have done the last 4 years. VA allows for an 8% seller credit, but only 4% of that can cover closing costs. So you can't use 5% to cover closing costs and 3% to pay off debt. Only 4% can cover closing costs, but VA allows an additional 4% seller credit that can be applied to someone's debt and pay it off. It's a really great program.
That is great.
Not a lot of people do it. I know Dale's done it more than me, actually, but it's hard to get 8% seller credits right now. But if you need to pay off, let's say the house is 400,000, you get a $16,000 credit just to pay off debt. That's going to eliminate a lot of your credit cards or your car. And now with the prices, with more listings coming available, you might see some more willing sellers to do that, to give you that credit to make you qualify. Maybe you got a veteran selling that cares about this veteran and wants to help the other veterans. So
let me add something, Alex. Let me add something along those lines. I have done deals where the realtor says, "Oh, you can't go more than 4% on VA." I go, "That's true and not true." So I've had a borrower. He had like a 540 FICO score a couple of years ago, and at the point, or maybe like a year and a half ago, it cost 4 points for his interest rate because of his FICO score. But we got the total 8% from the seller because the VA allows not only the 4%, but you can contribute towards a legitimate discount points, right? Yes. And so we were able to make the whole deal work because we drove the rate down.
Yep.
Did they raise the price of the house to help offset the credit?
We did. So initially the price of the house was lower and we matched it up with its appraised value. And then we went to work on the discount points.
There you go.
That's how you do it.
Yeah, it's hard to get 8 points unless the market is a little softer or there's a friendly relationship between the buyer and seller or a connection because they're both veterans. It's hard to get 8%. I'm expecting that.
Oh, it is.
6% might be doable though. You don't have to get the full 8. Maybe it just takes 2% to pay off your credit cards to qualify you.
Mm-hmm. Either pay off the credit cards or discount the rate. Either way, it's going to help that DTI.
Right.
Yep.
Absolutely. 100%.
That's all I could think of really quickly is today.
I think that's a lot of good. I think we pointed out a lot of good things. There's a lot of creative strategies. Ultimately, you want us to take a look at the file and let us go through it, and offer some suggestions and see what's viable or not.
Right.
I don't like giving my fellow loan officers secrets, but whatever,
Right. So, I don't have any more either. I think we talked about all of them.
Yeah.
For those of you who are watching, I'm going to put links down in the description to where you can find Alex and Dale with the website gustincho.com. And also there's a really great forum where you can ask questions in the forum. I'll put a link to that as well. And I want to thank both Alex and Dale for joining today. It's a great discussion. We're going to do it again. And if anyone here has any questions, you can, again, contact us or leave them in the comments down below. We'll answer pretty quickly. And especially if you're dealing with a situation with high DTI, I think you can see that we've got a lot of creative ideas where the three of us can help you. So I appreciate you all watching. Again, thanks to Alex and Dale for joining. I hope everyone has a great night. And
Happy New Year.
Happy
yeah,
New
Happy
Year.
New Year. And if you're watching this in July, Dale with the Christmas tree behind him, yeah.
I got the Christmas spirit. I can't let go of it. I always make my wife keep it up a week
Yeah.
longer than 2 months.
If it's July, happy 4th of July.
Yeah, exactly. All right. Have a great night, everyone.
Thank you.
Take care. Bye-bye.